Let's go over investing opportunities in Northern Nevada. Now, in the market of this video, people would think there's no way investing can occur in Northern Nevada. Far from the truth. There are countless people right now investing in real estate and making great returns. The difference is it has to be done a special way in this market. So there's always investing opportunities in real estate no matter which market you are in. It's just depending on the market, it has to be invested in different ways. Let's go into details on how that works. Let's talk about our market overall compared to the nation. So it's one of the top places that people do invest in, with our landlord favored rules compared to other states that have tenant favored rules. At the time of this video, we don't have rent control, even though year after year after year they try to make it happen, but it's been failing. It's back in the ballots again, trying to get it through. A big reason people are moving their portfolios over to our market. And then, of course, the tax environment. Since it's Nevada real estate, it's taxed on Nevada guidelines. So we don't have income tax here. Investors that hold Nevada companies only file federal returns. So we're seeing a lot of people selling their real estate in outside states and moving their money here and investing, even in today's marketplace. Now, with rising interest rates, markets can soften a little bit, but nothing really dramatic. In today's marketplace, interest rates are one of the biggest movements of how hot or cool a market is. As interest rates go up, that can cause a selling market to cool down. But for buyers, that could be even more opportunity. Investors recognize this. And there are serious sellers out there that are not disconnected with the market, that are working with people to accommodate for the changing interest rates, whether it be credits to help them get their rate down or just different prices altogether. We'll start with the single family investment opportunities, but there's also great multifamily opportunities as well. Median price right now in Northern Nevada is about $600,000, specifically Reno and Sparks. You go in the other surrounding cities, they can be a lot lower. But there still is inventory sitting around the 450s, 300s in Reno, but be prepared to have competition, because as an investor, you're also going up against owner occupiers. Because when you go with the median income of our area, it really translates to about a 375. 400 purchase price. So even in cooling markets, when you enter that price range, do expect competition because there's so many buyers that can afford those type of homes. Even though inventory is improving, overall, it's still considered quite low. We have about 2.5 to 3 months of inventory right now. When we start getting into more of a buyer's favored market is when we start hitting the 6 month and beyond. It's been years since we've had 6 months of inventory. And with people moving here the way they are, and so few homes selling, we don't expect it to get to that for quite some time. And it'd be hard to even give a forecast of when that would come, if ever. Why is there so much investment here? Employment, that's one of the biggest things. Northern Nevada has a very diverse employment outlook. We're not heavily favored on the service industry, the hotel industry, the tourism industry. We're actually a big tech capital. We have what's called a hyperloop. It's a super high, fast internet that's unique to only certain parts of the United States. We have one. So a lot of tech companies are coming here to patch into that, especially a lot of data centers, things like that. And we have a lot of land. So it's really easy to build massive data centers outside of our city limits. And there's many under construction as we speak. Plus, with the tax environment, employers are doing the same thing as real estate investors are. They're moving their companies here for easier tax environments, easier building permits, those type of things. One of our largest employer streets, USA Parkway, drive out there right now, you'll see massive construction underway. As soon as those are done, employment follows. And it's actually reaching the point of being built out. So there's actually a phase 2 happening right now of the Reno-Tahoe Industrial Center outside of Fernley, which is going to make Fernley a massive investment opportunity market as well. Investors know this. We're already getting calls about people wanting to invest in Fernley instead of Reno and Sparks because of those opportunities and employment's heading over. And we're not talking about small companies. These are large, publicly traded companies that will result in thousands and thousands of more jobs in Northern Nevada, increasing the demand for real estate, but also increasing the demand for investors because they know they're having renters coming their way who are going to take these jobs. Investors also have a lot of room with the rents. Rents have been rising in general year over year, and especially those investing in single family, it allows them to outcompete, say, the apartment market. Because right now, let's say you buy a multi-unit, there's a whole huge multi-unit market that's been built of luxury apartments, 3-story, high-end granite countertops apartments. And that inventory has really spiked over the last 2 years. That's competition. But what's really tough for that always to compete with are single-family homes. So we are seeing a lot of investors right now purchasing single-family homes instead of investing in multi-unit, because that inventory isn't growing near at the rate of the luxury apartment market. And premiums can be charged because there's yards, garages, private space. Right now, overall median rents are about $2,200. If you go closer into Reno and Sparks, those rents are higher, typically $2,500 to $2,750. The larger homes can surpass $3,000 per month in rent. That allows for a lot of cushion for investing opportunities. Investors realize this. and investors are buying property from it. We're even seeing investors purchase brand new construction homes with the entire model to put a renter in. Now, some builders forbid this and only sell to owner-occupiers, but there are markets out there where a person can purchase new construction solely for putting a renter in there. Builders are actually taking advantage of this too. There are entire neighborhoods in northern Nevada where the model is never to sell the brand new homes. The entire neighborhood is built for renting. This happened in Fernley. There's one under construction in North Valleys right now, and you'll go in thinking that it's brand new construction to buy, and it's not. The builder's going to hold it, and they're renting them out. So there's a massive market for single-family homes solely for the purpose of renting them to tenants. Close to the college is another massive market. Now, this also tiptoes into the multi-unit market as well. We do find that rents are at a premium closer to the college. College students, college housing rents at a premium in typical working tenants. So again, why our market? Median price around $600. Sounds high to folks who live here, but in other markets that's considered lower. We still only have about 2.5 to 3 months of inventory. We have a lot of migration into our area because of the growing college campus, all of the tech industry jobs that are coming, and all the tech-related manufacturing jobs like lithium batteries, those type of things. So let's talk about where to find good investment opportunities. Again, this part is not market specific. There are many, many markets where these indicators will work just fine. Finding investment opportunities. First, let's start with location. The closer you are to amenities, retail, restaurants, renters are going to be more likely to pay premiums for those. They're also going to be easier to rent on tenant turnover. Neighborhoods like Midtown, the college, Old Northwest Reno, essentially take the McCarran Loop and stay close to the McCarran Road. That's going to keep your tenants close to amenities, close to the freeways. Focus on the newer areas. You'll find that tenants are more attracted to a newer neighborhood than an older neighborhood. Now, this contradicts the McCarran thought because McCarran has been built for many years and all the new construction is spread out away from that. But newer neighborhoods work great too. And by newer, let's make that a little more broad. Let's say built within the last 20 years. That's a really attractive area. So we're talking about Damonte Ranch, South Meadows, Somerset, and in Sparks, Wingfield Springs. These neighborhoods are really attractive because folks that aren't from our area who haven't done a lot of research on the different neighborhoods, we've learned they view those as sure bets that the neighborhood's going to be okay. They're being held accountable through HOAs, so they don't have to worry much about how their neighbors keep their homes. Renters do take those type of things into consideration. So we find those great areas to attract an out-of-town renter with ease because they know they don't have to overthink if they're moving into a good neighborhood or not. This also pertains to North Valleys. North Valleys has been building at a more aggressive rate than the rest of town. So all those newer homes in North Valleys are great options. And now with the freeway expansion that's going to be done next year, commuting is going to be even that much better. And with that growing population, it's only a matter of time before retail, restaurants, entertainment follow. You're seeing that happen right now in South Reno, the huge retail complex called Downtown Damonte being built, with restaurants, bars, entertainment right in the heart of the neighborhood. So these are great neighborhoods to take into consideration on where to go. Now let's talk about other cities. Fernley is one of the biggest potentials right now in northern Nevada because Reno and Sparks in general is about built out. There's not much room left because we're surrounded by mountains. Fernley, on the other hand, still has tons of space to build and expand. And now that's going to be the town that's the heart of phase 2 of the Reno-Tahoe Industrial Center. So it's only a matter of time before that's going to be a massive employment hub that will attract employees from all over. And here's the plus, prices are lower there right now. $350, $400, $450 are very common prices there. The median price is not $600. So I think that Fernley is going to be one of the biggest investing opportunities over the upcoming years. So let's focus on cash flow and the numbers. One of the biggest things that investors need to focus on is positive cash flow, making sure that the rent covers all the expenses and then collects more money on top of that. And this is where each market is different. In certain markets, less money can be put as a down payment to get that positive cash flow. In other markets, more money has to be applied as a down payment to the investment to get that positive cash flow. Here's a perspective. If you pay cash for an investment property, there's positive cash flow. The only time that cash flow can turn negative if there's major repairs. But if you do a home inspection and focus on properties without major repairs, then you can operate that property with a high level of confidence. Now let's work backwards from the cash purchase. If you borrow some money, some of that cash flow's got to go to the bank. And based on your down payment, the higher the down payment, the lower the amount goes to the bank. And that's really where the math kicks in on positive cash flow. So let's take today's marketplace versus the COVID market. COVID market money was basically free, 2% interest rates. So investors were able to purchase properties with far lower down payments because they didn't have to give so much to the bank. Now, in today's marketplace where rates are reaching 7%, 8%, 9% for investors, there's still positive cash flow to be made. The math is just different. The down payment has to be increased for the positive cash flow to take place. So it's not that there's not investing opportunities in today's market, it's just the math is different. But that doesn't mean there's not opportunity. There absolutely is, and investors are doing it every day. So how much positive cash flow should a person have? This is really up to comfort levels. Most of the investors I see have a comfort level of about 250 to 500 positive cash flow month over month. That gives them enough cushion to deal with maintenance costs, things like that, while still having an acceptable return. Now, some that might feel uncomfortable. Maybe somewhat 500 to 1,000. It's just math. So then basically what happens is you work with your lender, figure out how much you have to put down to get the positive cash flow that you need. So the biggest difference between today's marketplace versus, say, a COVID marketplace is investors are still buying property, but maybe not quite at the same pace. Maybe instead of not buying 2 properties, they're only buying 1. Maybe instead of not buying a 4-bedroom house, they're only buying a 3, because they're still going to have limitations of how much they have saved up to contribute to that investment. But it still doesn't mean the returns aren't there. They are. Now, there could be value adds in our marketplace as well. I talked about newer homes are more attractive to renters than not. Well, that argument could be applied for remodeling. Maybe there's opportunity to buy a property and then refresh it, do a level of remodeling to attract a tenant that will pay more. Those value add opportunities can improve return on investment, especially if you're an investor who has the ability to refresh, remodel properties not at full retail general contractor costs. That allows for even an improved return on investment and falls into the category that tenants are attracted to newer homes. Remodel homes falls in that same category, and they tend to pay higher rents. Some of the biggest things investors look for is to really avoid major costs. Unless they're getting that discount reflected in their initial purchase price, it's too far risky for a landlord to purchase properties that need really expensive improvements, especially because there's enough inventory to move on and find other houses that only need minor, predictable repairs. There is a market out there where investors will buy heavily dilapidated properties, but it's not that common because that involves risk. And a real estate investor really wants to be tight on their numbers, precise on their calculations, because there's not a lot of margin for error, but there's plenty of inventory out there after learning through a home inspection what repairs are needed and not. But a savvy investor knows everything can be solved, everything can be fixed. So what things should be avoided? Foundation can be a big risk for an investor because the calculations can be off tens of thousands of dollars. There's enough inventory out there not to have to worry about homes with foundation issues. Roofs are fixed costs, water heaters are fixed costs, furnace are fixed costs. You can be very finite in the estimates that you receive. But that's the one thing I've learned. The biggest one is unless you have the skill set to do foundations, which a very small group of contractors do, that one can be very high risk. And we do find investors steer away from homes with foundation issues because the questions are too open-ended. If you do have known major repairs, negotiate it prior to owning it. Get that purchase price down so that there's room for improvements. Here's the kicker in that though, is that it's not like it can always be financed. So if you need a new roof and that's cash out of pocket, there might not be enough room for that to happen. If you're putting a down payment on a house, you don't have the extra savings to put in that roof, so it might not be the right fit. Yes, construction loans are available, but there's lots of red tape, and we're really seeing in the market right now that it's not really happening. So if the seller's not agreeable to put on that roof prior to closing, it might not be the right investment. Owner occupying, there's a lot more different variables. We're not talking about owner occupying. We're really talking about cash flow and investments. So if you are a person putting a down payment on a house for investing, it's very difficult to carry forward on major repairs and still have it cash flow correctly. Really, the only option is solving it through the seller, because if you take it upon yourself after close, it can really mess with your returns. But sellers are problem solvers too. And actually, most of the time, we see solutions. We see the seller giving the buyer back money to put on that roof to do the water heater, or they'll just do it themselves before closing. And if that happens, your down payment stays the same and the numbers make sense. So do keep an eye on major repairs because it can really mess with your return on investment. Factors to avoid: research to be thoroughly done before completing the sale or making the offer. Understand the rent rates that you can predict. There are rental tools out there. Our agents have tools out there to provide full rent analysis on properties, so that way you really understand what income you're analyzing. Make sure you have a clear picture of the financing that you're going to use with your lender. It is higher than an owner-occupying offer. So you're going to have to work backwards and figure out how much down payment you have to do to get the payment where after rent results in positive cash flow. Every market, there's opportunity, but every market has a different down payment that it makes sense. In lower interest rate markets, less down payments can be used. In higher interest rate markets, those down payments need to be increased. Both have returns though. Truly understand the property's condition. It is one of the biggest wild cards that can mess with your return on investment. If you have costs you did not predict it can completely destroy the return on investment that you were seeking. You have to thoroughly understand the home's condition. It doesn't mean the home has to be perfect, but it means you have to understand it and calculate it accordingly. Use caution on properties with HOAs. HOAs is a big issue that's changing constantly right now in Northern Nevada, so use caution as an investor. There's opportunity with condos and investments in real estate opportunities, but make sure you understand the situation of the HOA. Because if they triple the HOA in 1 year, there goes all your positive cash flow. So make sure you invest in communities if you choose to invest in condos. I know many investors who are making great returns on condos, but you have to make sure you have a stable HOA that you're investing in. You have to make sure they're not going to tack on a $10,000 assessment because they have to change the plumbing. So if you are going to be investing in condos, great opportunities there. Make sure you understand the stability of the HOA. Make sure you understand, is there talks about them putting on a new roof and everybody's going to get a $5,000 assessment? You have to prepare for those things. Sometimes you can pass it on to the tenant through increased rents. Sometimes you can't, which means you, the investor, is going to eat that cost. But condos are a great way to get started in real estate investing. You just have to really understand your cash flow because there's a variable you have no control over, which is the monthly HOA fees, assessments being added onto the property. So just make sure that if you are going to be investing in a property with an HOA, understand the financial stability of it. Understand others are major upcoming repairs because you want to negotiate it that way in your offer so that you can be prepared and the cash flow still makes sense. What's a typical return on investment for real estate? So our market has been the same for quite some time. We call it cap rate. It's about 5 to 6%. Here's how cap rates work. The higher the return, the better the buy you got. Now, there is a point where the returns are too great and there's another investor that doesn't need that much. It's the same thing as underpaying for a property. You can expect right now in Northern Nevada to receive about 5 to 6% cap rate on investment properties. How is cap rate calculated? It's basically the total income, so the rents, minus the operating expenses of the property. Now, that does not take into consideration your mortgage payment. So it's only the operational expenses of the property. Maintenance costs, property manager, property taxes, insurance, that's it. People get confused sometimes and think their mortgage payment has to do with return on investment. It does not. When you talk about cap rates, you just talk about the total income, so the rents, minus the operating costs of the property. Now, some investors will add reserve into those operating costs, an accruing cash account. I get it, but I say use caution because your competing investors out there typically don't get too crazy with that number, because if you calculate too big of a pad, what you're really saying is all property's too expensive to maintain, and then you think everything's overpriced. That's not true. There's investors that are happening right now at a 5.5 to 6% cap rate, but without calculating huge big cash reserves as a part of that. So use caution because your competing investors out there aren't asking for a 20,000 cash reserve as a part of expenses. If you calculate that in, you're going to always think property's overpriced and then you won't be investing. So use caution in that logic. Really what happens is the positive cash flow of the property builds that account is how most calculate it. And especially people like in California who are moving investment properties over, they're not getting really crazy about the cash reserves as a part of their analysis and they're investing. Just use caution when you're thinking about calculating a cash reserve as expenses when thinking about return on investment. As a takeaway, every market has an opportunity for real estate investing. It's just the down payment changes based mostly on interest rates. As interest rates get higher, plan on putting more down payment on the property. As interest rates get lower, plan on putting down less. Be cautious about HOAs. Be cautious about major repairs. And think about investing in markets that are predictable, that an out-of-towner who doesn't know our area, where would they very quickly gravitate to? Those are great opportunities for real estate investing. Our team helps lots of investors run numbers, provide the information so they make educated decisions on their real estate investing. Whether they're investing from their savings or investing from other real estate properties, we can help provide that guidance. There's investing opportunities all around Northern Nevada. Take advantage of it.